Hey, what's up, guys? Today we'll talk about how to invest in private companies. Okay, let's start. Overall, it's much easier to invest in a publicly traded firm than a privately held company. Public companies, especially large ones, can easily be bought and sold on the stock market and therefore have superior liquidity and acquired market value. Conversely, it can be years before a private firm can again be sold and the price must be negotiated between the seller and buyer. In addition, public companies must financial statements with the Securities and Exchange Commission, making it easy to track their highs and lows on a quarterly and annual basis. Private companies are not required to provide any information to the public, so it can be extremely difficult to determine their financial soundness, historical sales, and profit trends. Investing in a public company may seem far superior to investing in a private one, but there are a handful of benefits to not being public. A major critics of many public firms it is that they are overly focused on quarterly result and meeting Wall Street analysts' short-term expression. This can cause them to miss out on long-term value creation operations, such as investing in a product that may take years to develop, forcing profits in the near term. Private firms can be better managed for the long term as they are out of Wall Street's reach. Being an owner of a private firm means sharing more directly in the underlying firm's profits. Earnings may grow at a public firm, but they are retained unless paid out as dividends or used to buy back stock. Private firm earnings can be paid directly to the owner. Private owners can also have a larger role in the decision-making process at the firm, especially investors with large ownership stakes. Types of private companies. From an investment standpoint, a private company is different by its stage in development. For instance, when an entrepreneur is first starting a business, they usually receive funding from a friend or family member on very favorite times. This stage is referred to as angel business, while the private company is known as an angel firm. Past the startup phase is venture capital investing, when a group of more savvy investors comes along and owners grows capital, managerial know-how, and other operation assistance. At this stage, a firm is seen to have at least some long-term potential. Past this stage can be mezzanine investing, which consists of equity and debt, the last of which will consent to equity if the private company can't meet its interest payment obligation. A later stage, private investing is simply referred to as private equity. It is a roughly $2 trillion business with many large players and others. For investors, the stage of development a private company can help define how risky it is as an investment. For instance, around 3/4 of angel investments fail. The risk falls the more development and profitable and private company becomes. The goal of many private firms is not to eventually go public and provide liquidity for company founders, so other investors, other private business may prefer to stay private given the benefits discussed above. Family businesses may also prefer privacy and the handling of ownership across generations. There are important matters to be aware of when deciding to invest in a private company. How to invest in a private companies? Early stage private investing offers the most investment operation, but is also the riskiest. As a result, joining an angel investors organization or investments group may be a good idea to make the process easier and the potential spares the investment risk across a wide group of firms. Venture funds also exist and solution outside partners for invested capital, and there are small or private business brokers that speculation in banks and sell these firms. Brewers acquired in also on operation and ironically, a number of the largest privately acquired firms are publicly traded, so they can be purchased by any investors. A number of mutual funds can also offer at least some exposure to private companies' expansion. Other consideration. Overall, it is important to realize that private companies are not liquid and require very long investment time frames. Most investors will need an eventual liquidity event to cash out. This includes when the company goes public, buys out private shareholders, or is bought out by a rival or another private acquired firms. As with any securities, private companies need to be valid to determine if they are fairly valued, overvalued, or undervalued. It is also important to note that investing directly in private firms is usually received for wealthy individuals. The motivation is that they can handle the additional illiquidity and risks that goes with private investing. The SEC definition calls this wealthy individuals, accretion investors, or qualified institution buyer when it is an intentional. The bottom line, it is now easier than ever to invest in private companies, but an investor still has to do their homework. While investing directly is not a viable option for most investors, there are still ways to gain exposure to private firms through more diversified investment vehicles. Overall, an investor definitely has to work harder and overcome more obstacles when investing in a private firm as compared to a public one, but the world can be worse is as there are a number of advantages. Complete risk-free with $100 million in virtual cash. Put your trading skills to the test with our free stock simulation, complete with thousands of Investopedia trades and trade your way to the top. Submit trades in a virtual environment before you start risking your own money. Practice trading strategies so that when you're ready to enter the real market, you will have the practice you need. Overall, an investor definitely has not to work hard and overcome more obstacles when investing in private firms as compared to the public one, but the work can be worse is as there are a number of advantages. Okay, that's all. Goodbye.